Okay, I think we'll start. I think we're quorate. We've got enough. Got plenty. Thank you all. Good morning. Thank you for joining our webinar on off payroll working. If you weren't expecting a talk on off payroll working, then this is not the one for you. But stay anyway, because it probably is relevant if you're a media or marketing services agency. So many of you probably know us already. There are lots of familiar names in the delegate list, but there are some slightly less familiar names. So for those of you who don't know us so well, we're leading accountants and advisors to the media and marketing services industry. We are part of top 20 firm Moore Kingston Smith, and in our West End office, although obviously not physically in our West End office at the minute because most of us are at home, as you can see, but we have around 100 professionals in our West End office that work exclusively with media and marketing services and creative clients, ranging right from startups through to multinational agencies, private equity backed agencies, as well as obviously some sort of sexy startups as well. So we're also part of More Global, which is our international network, which is in more than 100 different countries, so very well positioned to help our clients with their international ambitions as well, and to service them in a very joined up way. So today we're here to talk about off payroll working. So delighted to welcome Tim Stobbold, who I'm sure many of you will probably have heard before in the numerous different webinars that we've been doing for all the various trade bodies. So it's unlikely you won't have logged on to a webinar and seen Tim at some point, and you may even have read about his very expensive shed in his garden in the press. So Tim heads up our tax team and works very closely with our media and marketing services clients on all sorts of tax matters. So that might be pre-sale restructuring, R&D, employee incentives, transfer pricing, global mobility, doing quite a lot of work at the minute on employee ownership trust. I think he's working with me on a couple of my clients at the moment, those becoming a very popular choice, particularly given the potential capital gains tax changes that are coming down the track. So without further ado, I will hand over to Tim. Just before I do, though, please do ask questions as we go. Please do put them in the Q&A rather than the chat function. It's much easier to monitor, and I will either try and weave some of those questions in to Tim's presentation as we go, or I will save them for the end. But please do ask questions. Let's make this as interactive as possible, because I think that's the way that you will get the most out of it. Okay, over to Tim.
Brilliant. Well, thank you, Esther. Good. So off payroll working, it feels like it's a topic I've been talking about forever, as there's been a few run-ups at it, but we are careering towards the implementation date unless the Chancellor has another change of heart. So what I will try and do, if I can get my slides to work, is walk you through probably about 45 minutes of death by PowerPoint, making it hopefully as interesting as possible. Esther, I've invited to interrupt me as much as she likes as we go, if I'm saying anything that's not completely understandable, or if there are relevant questions coming in as we speak. So we'll see how we get on. So first of all, I'm going to just cover a bit of history, just to put what I'm going to talk about in context. So IR35 has been around a very long time. In fact, it's probably been around longer than some of the people we've got working in the business. But April 2000, the IR35 legislation was introduced, and that was to try and level the playing field between individuals providing their services through typically limited companies and employees. It required the individual working through the limited company to hold their hand up and say, look, really, you've got me bang to rights, I'm really an employee in disguise, and to put some numbers on their tax return that would end up with them paying lots more tax. People quickly worked out the revenue, once the rules were introduced, weren't doing an awful lot to police it. So for 17 years, pretty much everyone ignored it. I've met very few people over the years, independent contractors, who've ever actually declared an IR35 tax liability. The revenue estimated compliance with the regime was around about 10% of the relevant companies. I think that was hopelessly optimistic. If the compliance was around about 2%, I think that's probably more likely. So 17 years later, the government and the revenue sort of woke up to this idea that there was a whole tax regime that people were broadly ignoring. And they introduced off-payroll working rules into the public sector. And you might remember, if you picked up a newspaper at the time, lots of, sort of medical practitioners were saying, look, you know, I've been freelance forever and ever and ever, and now I've gone on the payroll, and therefore I'm going to retire early, and death rates will soar. Now I'm not curing people. Lots of those sort of panic stories. Public sector included the BBC and Channel 4, so there was a fair amount of backlash from the media sector as well. After it had been introduced into the public sector and private sector commercial businesses were just keeping an eye on it, we had a consultation a year or so later, May 2018, where the government said, look, this is working incredibly well in the public sector. Everyone loves it. It's a runaway success. We've commissioned a survey to prove that, which they did, and it wasn't very convincing. They did a consultation saying, should we or shouldn't we introduce these rules into the private sector? To which everybody responded, us included, saying, no, absolutely not. These rules will limit the liquidity of the labour market. It will increase costs on businesses at a time they can least afford it. And the revenue came back March 2019 and said we've had an overwhelming support for introducing these rules for the private sector, and therefore we're going to introduce them, and the only thing to consult on now is the detail of how these rules will apply. Lots and lots of resistance carried on. February 2020, after a promise during one of the election campaigns to review it, the HM Treasury published a review of the rules, but they confirmed they were still going ahead, but there were a few concessions granted, which I'll cover later. And then, if history had run along a normal course, 6th of April this year, we'd have had the new rules applying to the private sector. But as we all know, history had to be rewritten due to COVID. So the 6th of April 2020 date, we found with just, what's that, a couple of weeks, 2 or 3 weeks before the go live date, the Chancellor, well, actually wasn't the Chancellor, one of the MPs in PM's questions, I think, announced that it was going to be delayed by 1 year, 18th of March, to which we all breathed a sigh of relief. It was very sensible to delay it for a year, because at a point that businesses are struggling, it's pointless loading additional cost onto them. May 2020, David Davis, MP, sought to try and delay the rules by a further 3 years with a finance bill amendment, and he failed by some large margin, understandably, as he was challenging the government. And therefore, as it stands at the moment, 6th of April 2021, these new rules, which I'm about to spend the next little while explaining, will apply in the private sector. There's a bit of me, I'm a hopeless optimist, that Rishi Sunak will say, look, things are still a bit shaky out there in the private sector world. Delaying these rules again would make some sense to take some of the pressure off businesses. But these new rules are going to collect a load of tax, and as you'll all have read in the last week or so, the Institute of Fiscal Studies say we need to collect an additional 40 billion a year to drag ourselves out of the hole that we're in. So the Chancellor giving up on an early bite of the cherry, you know, does feel a bit unlikely, although, as I say, I remain a little optimistic, but please don't count on them being delayed again. Right, so what's this all about after the history? So personal service companies, in tax we love an acronym, so if I mention PSC, personal service company, you'll know what I'm talking about. From April 2021, businesses that make payments to personal service companies, typically that's going to be a limited company owned by a worker, a contractor or freelancer that you use. They're going to be subject to a new tax regime. Now, if the person making the payment or the business making the payment is small, and I'll come on to what that means in a little while, then you've got a period of grace. These rules won't apply to you now, so the business making the payment, nothing really changes for them. But if you're not small, then you need to consider whether the worker, in this diagram at the end, the worker providing the services at the end of the chain, you need to decide whether they're operating a bit like an employee. If they're not operating like an employee, and I'll come on to what that means in a moment, then nothing changes. The worker provides their services through their own company, their PSC, their own company invoices the client for those, and then the client pays the PSC gross at the end. That's how things are. And if the worker's not acting like an employee and the client is not small, so the person buying the services is not small, then everything carries on as is. However, If the work,
Tim,
yep.
Tim, is it worth just clarifying what small means? I mean,
Well, in about 2 or 3 slides, I will, because it's not a simple. It's not a simple explanation. So I will, and I think, Esther, as you and I chatted before getting started, a lot of the people attending this webinar probably will be small.
will be, yes.
But I'm going to come on to that, because small is an exemption at the moment. It probably won't be around for very long. And also, if you are small, the rules are still relevant to you, because the rules actually might be a bit of an opportunity. Again, if you can bear with me for a couple of slides, I'll go through that in just a minute.
Somebody has asked a question. They've said, is it only limited companies, i.e. freelancers, that are limited, that we're talking about here?
Yes, I mean that question might have a couple of different layers to it. If you're engaging freelancers who are flesh and blood, so if Moore Kingston Smith decided to engage Esther Carter, the freelancer, and it was Esther providing her services herself and not through a company, pretty much a lot of what I'm going to describe today already exists, because where a business uses an individual providing their services as a sort of individual, not through a company, you already need to decide whether they're acting like an employee and whether they should go on the payroll. One of the main reasons for engaging individuals through limited companies is to avoid that problem of having to decide whether the person should go on the payroll, and that's effectively what's changing now. If the worker's providing their services through some other sort of intermediary, let's say a partnership, an LLP, or any other weird and wonderful thing they might have come up with, these rules still apply. I talk about personal service companies because most freelancers, when they operate through an entity, will operate through a limited company, not through any of the other weird and wonderful combinations of how they can operate. So I can see questions coming up. We'll get past this sort of beginning bit, and then hopefully as we get onto the small company definition, that will enlighten, I think, some of the points. So if the worker is operating a bit like an employee, again, I'm going to come on to what that means in a moment, they still provide their services to the end client. So the end client is still using the same freelancer. The freelancer's company, the personal service company, is still invoicing the client. But if they're operating like an employee and the client cannot rely on the small company exemption, the client is going to have to deduct tax and national insurance in the same way they would as if they were paying an employee. So it's this rather bizarre situation where you receive an invoice in the same way you might receive an invoice from Moore Kingston Smith even, but you'll receive an invoice from a supplier, but you're going to have to effectively put that invoice through the payroll. So what that means is, on the face of it, your worker's going to suffer a tax deduction at source on a payment to their company. And when I mentioned earlier, this is layering additional cost onto businesses who use freelancers, you're going to have to pay the employer's national insurance, and if you're big enough, the apprenticeship levy as well. So the cost is going to increase of using the freelancer by something up to 14.3%, depending on whether or not the apprenticeship levy is paid. This is only a deeming of employment status for the purpose of a PAYE deduction. They're not deemed to be an employee for any other reason. We're not giving them employment rights. We're not giving them any pension rights. We're not giving them entitlement to holiday. All this is a tax grab. Okay, it's a deeming of being an employee for PAYE purposes. Okay, so that's the background. We're looking at payments to personal service companies where there might in the future need to be a tax deduction at source. Right, I'll get on to some of the details. So importantly, I mentioned, as a sort of flippant remark, you might get an invoice from any supplier, for instance, Moore Kingston Smith. Now, if Moore Kingston Smith sends an invoice to one of its clients, should the client then decide whether or not whoever was operating or advising you from Moore Kingston Smith, were they operating like an employee? And the answer is no, and this is a subtlety that must be understood. PSC, again, as I say, tax practitioners love acronyms, personal service company. So we're only looking at engagements between a client and a PSC that are personal service engagements. So the question we have to ask is, does the client have a contract for personal service? So a contract with a company to provide the services of an individual? or does it have a contract for service? You know, for example, if we send you an engagement letter for audit, you're having a contract with Moore Kingston Smith for a service. There's no individual that's procured to provide that service. You might, Esther might sign the letter and she might send out one of 100 people to come out and do the audit, and that's a service we're providing rather than personal service. So in looking at this, there's been lots of work in the sector at looking about whether contracts for personal service can be changed into contract for services. That typically means that we're looking at businesses that are a bit larger, where there's the ability to substitute workers. So you would engage a business to provide a service, and that business will provide the service using any one of its contractors or employees. There is a shift, and you have to be careful about this, about other advisors out there saying that they'll transform all of your personal service contracts into contracts for service and will save you a fortune. The revenue are already pretty hot on this. If you've got an artificial statement of works arrangement or contract for service arrangement, the revenue will come in and say, well, look, that's just smoke and mirrors. You know, you've fiddled the arrangement to try and save some tax. But we have, when I've presented this to groups of contractors, there's always been a murmur in the room about whether a lot of the contractors, the freelancers, should club together, form their own genuine consultancy and start consulting rather than as individuals, but start providing a service where they look a bit more like a big consultancy rather than an individual personal service company. I think I only put this picture up on the screen because it's something we've already seen happen. So if there's a large business that's already using lots of individual personal service companies and also uses some small businesses as well who provide a service. So let's say the large business uses an agency to provide, you know, a service, but because the agency doesn't have the entire skill set needed, the large business might employ some freelancers as well directly. We have seen this done, and I think you've got to tread with enormous care, but it is an opportunity for small businesses where the small business says, well, look, we'll engage your personal service companies ourselves, and we'll continue to provide you a service. And what that does here, the large business would be, on the left-hand side of the screen, the large business would be potentially deducting PAYE and paying employers' national insurance from the payments to the personal service companies here. But because of the small companies exemption, which I'm going to move on to talk about in a moment, the small business can still pay the personal service companies gross on their invoice without a tax deduction at source. And provided that's a genuine consultancy service being provided there rather than personal service, we haven't just become an employment agency, then that works to sidestep the rules for the short term. So I do think that's a potential opportunity for small businesses. So we've seen it happen in a couple of occasions already where there's been some good collaborative work done where the use of the contractors has shifted from large businesses to small businesses.
Tim, does it make any difference if what if the personal service company is, somebody's given an example here of what if it's a French company and you are small and it is an employee-like relationship rather than anything else?
These rules have a territorial limit to them. So if the personal service company is a French company and it employs a bloke or a lady sitting in France and they do all of their work in France, that's fine. The territorial extent of these rules says if the individual behind the personal service company is a non-resident, so resident in some other place, then these rules don't apply at all. So whether the person making the payment to the personal service company is large or small, we can ignore the rules altogether because the worker is a non-resident. And the rationale behind that rule is if you put that person on as an employee on the PAYE, you wouldn't be making a tax on national insurance deduction at source because they're not within the UK scope. If on the other hand it's a French company that happens to employ somebody sitting in London, these rules do apply, because the territorial extent is looking at the location of the worker, not of the company. Otherwise, there'll be a complete boom in selling overseas companies for freelancers. Right. I sort of give this sort of slightly contrived example just to illustrate some of the complexity of these rules. When the business using the freelancer receives an invoice, that invoice might say day rate £750, end of story, in which case it's fine. The amount that goes through the PAYE is the £750. But if you're receiving a slightly more complicated service, you've got a day rate of £1,000. They might have incurred some materials, they might have recharged you some travel, they might have tried to sneak through a clothing allowance as a slightly contrived element to this invoice. And if they're charging VAT on top, you know, the question is, what do you actually put through the PAYE to make the tax deduction at source on? Well, the amount you put through the PAYE, you take the value of the invoice, you deduct off the VAT, and you deduct off any other expenses that would be deductible if incurred by an employee. So you can always reimburse an employee's travel expenses if it's travel to a temporary workplace. So in that example, the amount that goes through the PAYE is the day rate and the clothing allowance, because that wouldn't be a deductible amount. If you think about the processes within your business, if you're having to actually tackle this and you're getting, your bought ledger receives its 20 invoices at the end of the month from the 20 freelancers you use, normally you would just pass those through to payment, end of the following month you'd pay them, and end of story. Now the purchase ledger, if that's the right term to use these days, the purchase ledger needs to actually separate out the invoices from freelancers that fall within these rules, pass those invoices to payroll. Payroll is going to have to strip out all the amounts that don't go through the PAYE. Payroll will then calculate a tax and national insurance deduction, will pass the invoice back to purchase ledger with a tax and national insurance deduction probably written on the front in biro, and then purchase ledger are going to have to remember to pay the right amount. And then the freelancer is going to explode to say my invoice was for £1,710 and you've only paid me £1,200. So there is an element of chaos that's going to ensue on the actual administration of this. Now,
Tim, what about contracts that span April 21? Somebody's asked if they're about to hire somebody on a PSC contract, can they do it now and just pay them, you know, gross under the PSC contract and then flip it over if they need to post April 2021?
The rules, when they were very, very first announced, the rules were sort of slightly dumb, and they said any payments post April 2021 would be within these rules or need to be considered for these rules. In the review in February 2020, that was changed. So now it's only that the only time you need to consider these rules is for services rendered after April 2021. So if you've got an invoice possibly that spans the period before and afterwards, you'd need to work out which services were provided before and after the cut-off date. Ideally, you'd ask your freelancer to invoice separately, so less will go wrong. But if you employ a freelancer now, at the end I've got a sort of list of actions you should consider. You need to make sure in your freelancer contract you've got the right to deduct tax and national insurance at source, if indeed that becomes necessary, because otherwise when you make the tax deduction after April 2021, you're at risk of your freelancer suing you for breach of contract. I'll come on to that again at the end. Right, I'm gonna canter on. These slides are going to be circulated afterwards, so don't worry if you're not taking it all in as we go through. There's some detail there, I think, as we're slightly behind on time. I'm not going to cover some of the really fiddly detail. Anybody who's on the HR side and is already wondering when you put them through payroll what you should do in terms of tax codes, pretty much in most cases you're going to be deducting tax at the basic rate. If you're a freelancer, that's almost certainly going to mean you're going to have the wrong amount of tax deducted and you'll have to true it up on your tax return at the end of the year. But again, I'm going to just canter on some of the more important bits just to make sure we keep to time. Right, small company exemption. This is the point you've all been waiting for, those who aren't familiar with it. So the small company exemption, you'll see some very big numbers in the middle of the page there if you're a small agency. It's the same test, or the core of it is the same test actually that you might be familiar with for accounting and audit purposes. Now, this just deserves a little bit of history being explained. Just, first of all, in order to be not small, you need to have to have 2 out of 3 of these, or sort of fail 2 out of 3 of these tests for 2 consecutive years. So if your turnover is if your turnover is less than 10.2 million, your gross assets on the balance sheet are less than 5.1, but you've got 60 employees, that's fine because you only fail 1 of the tests. If you fail 2 of the tests for 1 year only, you're fine, you're still small. It's only where you fail the tests for 2 consecutive years. Now, where things went slightly wrong when these rules were first discussed all those years ago is they said, look, the set of accounts you need to consider, the set of financial statements you need to consider when applying these tests are for your year end that ends before the tax year in question. So, to which everybody said, well, look, if my year end is 31st of March, as a lot of year ends are, and the tax year starts 5 days later on the 5th of April, there's not a hope in hell of Esther having moved quick enough to prepare my accounts in 5 days. Not even Esther can do that.
Believe me.
to tell me whether my turnover is greater or less than 10.2 million or my balance sheet's greater or less than 5.1 million. You know, and that's a real concern if you're on the cusp of these tests. The government then came around and said, well, look, what we'll do then is, rather than considering the set of financial statements that ends, but the year end ends before the tax year in question, we'll look at the filing date for those financial statements. So what that means then is, in considering these tests, let's say you've got a March year end, your filing date for your March year end accounts is 31st of December. So for the tax year, which is starting on the 6th of April 2021, you're considering your March 19 and your March 20 accounts to see whether you've got 2 consecutive years of breaking 2 out of the 3 tests. So that table, these will be in the slides. If you're on the cusp, it's useful just to refer to that to work out what are your relevant years. You can see, look, if you've got a December year end, your years are December 18 and December 19. Those are years that the word COVID was not really muttered. So the way the tests have ended up, the COVID years, which are really your classic year end, December 2020 and March 2021, your COVID years aren't considered at all for whether the rules apply to you from 6th of April 2021. So if you were above, you've always been above the turnover and asset and employee limit, but COVID has had an effect on your business, you've had a drop in turnover or a drop in headcount, that would normally cause you to be small. And you might say, well, look, if there's one good thing about COVID, it's taken me out of these rules. But the COVID years won't take you out of these rules until the following tax year. So that the COVID years are not considered until you're assessing whether you're small for the year 2022, 2023. We've made that point to government and to the revenue in various forums. They feel, you know, fairly unsympathetic about it. So if you are small now but weren't small in those earlier years, you're probably still going to have to comply with these rules for at least the coming tax year. Now, employment status, I used that rather woolly phrase at the beginning, if your freelance is acting a bit like an employee. So if you're small, and I would guess at least 2/3 of the people on this call are small, I'll go back to something which I skipped over. Right, last bullet point on that page, the small company exemption is a sop to a lot of lobbying that took place to say, look, small businesses just can't deal with this. You know, the government said, well, we're ploughing ahead, but there'll be this small companies exemption. It won't be around for very long. Okay, my prediction is 3 or 4 years before whoever is the chancellor at that point stands up and says, look, in the interest of simplicity, we're going to level the playing field, and now everybody will have to apply these rules. I think it's still, if you're small, worthwhile understanding these rules, because it does give you a competitive advantage in the freelancer market when you're engaging freelancers than your larger competition. I'll come back to that point a bit later as well. So, employment status. When you determine employment status, if you are within these rules, you're not a small business, you have to issue a status determination statement, an SDS, another great acronym, to your freelancers before you make a payment to them. Effectively, you need to tell your freelancers whether you're going to treat them like an employee or not. If you've got a very long contractual chain, let's say you're using an employment agency and they then find the PSC, you're having to issue the status determination to the employment agency, and they pass it down the chain to the PSC, and I'll cover that in a bit more detail in a moment. Yeah, and then the last point's a bit more detail. If you've got a very, very long contractual chain, it's a complete daisy chain of passing these down the chain. But so when you're assessing employment status, there are 3 tests which come out of a very old case all about mixing up concrete in a construction site, where this is called the irreducible minimum, the factors that are needed to be in place in order for there to be an employment relationship between a client and a worker. So an employer controls its employees, and the control has 4 pillars. An employer controls what somebody does, how they do it, when they do it, and where they do it. An employee has to provide their service personally. An employee can't say, I'm not coming in today, I'm sending in my mate Dave instead because I feel like doing something else. An employee must provide personal service. And with an employee, there are mutual obligations that the employer is obliged to provide work, the employee is obliged to do it. And that's called the irreducible minimum of employment. If you break, in theory, this is what the tribunal says, if you break any one of those factors, then there isn't an employment and that there's mountains and mountains and mountains of case law around these three tests. The other tests which come up and are often talked about are all subsidiary to those main three, but it's still important to a degree. It is the individual doing the work taking any financial risk. An employee gets paid whether they do the job well or badly. A freelancer might need to put right any bad work in their own time. They may have priced it wrong, so they might make a loss on the job. You know, employees are invited to the Christmas party. They're part and parcel of the organization. Freelancers shouldn't be invited to the Christmas party, although often are, and so on and so on. So there are those subsidiary tests. Now, the mountains and mountains of case law, which is emerging almost on a daily basis, is too much for, you know, most tax practitioners to keep on top of. So how would actually businesses in the private sector keep up with it? Well, you don't need to, because we've got the robot, and the robot, and I've done this seminar, and apologies those who heard me say all this before. I do this webinar in a room, and I always ask people to try and guess who the robot is, because it's a big part of my childhood. That is Marvin from Hitchhiker's Guide to the Galaxy, and that is exactly what the revenues robot looks like in my mind, at least. And the robot can be accessed on the link at the bottom of the page. And what this is an interactive tool that the Revenue have produced, where it asks you a load of leading questions around the tests of control, personal service, not mutuality of obligations, which is a massive weakness in the tool, and asks you around financial risk and all sorts of other things. And at the end of spending 10 minutes filling out this interactive tool, the tool tells you one of three things. It either says you are within IR35, so you are to be treated like an employee, or it might say you're outside of IR35, you can carry on having your invoices being paid gross, or it might say, I don't know, you know, it's too marginal, you know, go and find a tax advisor and they'll try and give you a steer on what the answer is. The tool is very, very unpopular. Launched back in 2017 when the public sector regime came in. It was revised in December 2019, but not in any material way. And the only other thing I can see has happened since then is we've now got the tool in Welsh, if anybody wants to really challenge themselves on filling out an employment status tool in Welsh. Although, if you use the tool, and I bet a number of people on the webinar have tried to use it, really, there's only two ways of getting a self-employed or an outside of IR35 answer. Either you need to be very strong on control. So when I say very strong on control, I mean you don't control the worker at all. You don't control where they do their work, when they do their work, how they do their work, or what they do. I mean, which you know really means you've got a completely loose cannon as a freelancer. If you're very strong on control, you do need to scoop up one other test along the way. And when I've been doing this for clients, normally the financial risk test is the other one to pick up, which is if the freelancer does a bad job, they have to put it right at their own expense. If you can be very strong on control and you can scoop up one other test, probably the financial risk test, you will get a self-employed or outside of IR35 ruling. The only other way of getting a certain outside of IR35 ruling is to be strong on the personal service test. If you say our freelancer doesn't need to turn up, they can send a substitute along and they meet the cost of that substitute themselves. So it's not that they just introduce you to somebody else that you pay, it's they find somebody else and they pay that person. Then strong on substitution is pretty much a home run. That will give you a self-employed answer as well. There are very few other permutations that will give you a self-employed answer. There is the question, you know, should you, if you are within this regime, if you are having to consider whether you need to deduct tax and national insurance from the payments to freelancers, should you use this tool given how unpopular it is? And I think that's a really difficult question, because if you choose to use some other method of determining employment status, you know, you design your own checklist, which 99 times out of 100 says everybody's self-employed. When the revenue turn up and say, look, show us how you were determining employment status, and you say, well, we ignored the tool because everyone agrees it's rubbish, the revenue will say, well, we don't think it's rubbish. We think it's an accurate reflection of case law. And if you get this wrong, if you don't deduct tax from your freelancers, and you were obliged to deduct tax, that liability lands back with you. And the revenue won't come out in year 1, but they'll come out in year 3, 4, or 5, because they can scoop up at least 4 years of back taxes. And if you've got a big freelancer population, getting this wrong will kill the business, because the liabilities that you'll need to pay over to the revenue will be so large that you'll question whether you can even survive. So I think erring on the side of caution and using the tool at least as a starting point is the right place to go. If the tool is giving you an answer that's completely counterintuitive, yeah, by all means come and talk to us, and we'll explain why. And it may be you can change the way in which you engage with freelancers to get a better answer, but the tool is definitely the starting point, I'm afraid.
Tim, who's I've got a good question here, and sort of whose ultimate responsibility is it to make the CES test? So if they've got an example where they hire a PSC on a TV production and the CES checker test says that it's fine to continue paying gross, however the broadcaster who is paying them for the project says that they are also assessing this individual because they work with them as well, and they've assessed that they need to be taxed at source. So they're sort of saying whose responsibility is it to make the assessment, and do we have to tax and pay national insurance even though their own assessment would say that we don't need to, and that they can continue paying gross?
It feels, I mean, it's a slightly unusual situation because the person who should be making the assessment is the person who's receiving the services. And this comes back almost to this contract for services, contract for personal services point. If the person that's asking the question is the one receiving the services, but they might onwardly supply a service to a broadcaster, that onwardly supplied service might be a contract for services rather than a contract for personal services. In which case,
they're saying that the broadcaster uses them consistently all year, whereas obviously the TV production company is just using them on this one particular project.
Well, I
so
think
they're different answers.
Yeah, I think that's fine, and I think that's expected in the regime, that each engagement needs to be considered on its own merits. So if what we're saying is at different times of the year the broadcaster is receiving the services and sometimes the production company is receiving the services, you would do your own status check based on the facts of your engagement with the worker, and it's quite possible they'll come up with two different answers. You know, I'll come on to one of the cases for one of the Talk Sport presenters. He lost in his tribunal case because he'd been presenting the same show on Talk Sport for 18 years. So that longevity of using a single person counted way against him. If he'd only been picked up and presented his Talk Sport show, you know, once every 3 months, then it would be more likely he would have survived the test.
And we've got a few questions coming out. Somebody's asked, what if the test is inconclusive? Do you then just have to go with employment?
What you would no, if it's inconclusive, I think that can be quite helpful. First of all, I think you sort of game the system a little bit. You run the test again and again and again. I say it takes 10 minutes. I know certainly my team and my clients, you know, can get through this test in about 12 seconds. You know, you become so familiar with it, and you keep running it until you work out what the factor is that's tipping the balance. And then I think you explore that factor. If it's inconclusive because, let's say, you know, let's go back to this financial risk test, which is slightly more important than some of the other subsidiary tests. If it's inconclusive because the answer is, you know, if the freelancer does a bad job, do they need to put it right at their own expense? What you would explore is whether you can change your contractual terms with the freelancer to say, look, you know, Bob or Sarah, you've worked with us for years and years. You've never done a bad job in your life. Can we change your contract so that if you do make a cock up of it all, you have to put it right at your own expense, and that's going to help us get to the right answer. So I would certainly look at what's tipping the balance and see if you can change the way in which you engage with your freelancers. If changing the terms in which you engage with your freelancers is not possible, or you can't identify the factor that's tipping the balance, come and speak to somebody, you know, who lives and breathes in this area. I mean, we do this. We've got members of my employment tax team who do nothing but status reviews, and they will give you probably some other factors which are perhaps industry specific to what you're doing to consider. And as long as you document that you've done something reasonable, the revenue will probably be okay with that. You know, if they say, you know, there are things that are industry specific that the generic tool doesn't pick up, and you consider those as additional factors in the case where you've got an inconclusive answer, that I think that would be pretty good. The revenue would look at that and would say you've behaved reasonably, and would probably let that go through. That said, in TV and film, if you're not aware, and do drop me an email afterwards, there is a published guide on employment status for TV or people working in TV and film, which actually lists the roles on a film set which are automatically accepted as self-employed. So if you haven't seen that guidance, it's been reissued quite recently, let me know and I'll send you the link to it, because that might mean you don't need to use the tool at all.
And somebody's asked, does the scooping up of the back taxes apply to the years when you have the small business exemption?
No. The small business exemption is you get out of jail free card. I think where the small business exemption, I'll just cover this sort of one point because it's interesting. There's a fear amongst freelancers that when you put them on the payroll in April 2021, the revenue are going to look at that and say, well, hang on, that freelancer wasn't paying any tax under IR35. We're going to now open up 6 years of tax inquiries in the years gone back before April 2021. And the revenue have come out and said, look, well, we're not going to do that. We won't use any information that we gather in this new regime to open up prior tax inquiries unless there's another good reason for doing so. That same sort of amnesty, I suppose, for freelancers who might have not been fully compliant with IR35 doesn't appear to apply when businesses cease to be able to rely on the small company exemption. So if you're putting a freelancer on the payroll after ceasing to qualify for the small company exemption, that's not a problem for you, but I think that freelancer might get a fairly rapid visit from the revenue to say, why weren't they declaring any IR35 tax in the years after April 2021? Sorry, slightly esoteric point, but if there are any freelancers on the webinar, that might be of interest to you.
And somebody's asked as well, I mean, presumably the assess tool can be used for consultants who don't have personal service companies, who just send you an individual invoice. It's equally relevant.
Yeah. The assess tool will cover lots and lots of different situations, does cover those flesh and blood freelancers as well. And whenever you use the assess tool in any circumstances, you get a lovely little report at the end telling you how you answered the questions and what the answer was. Print that out, save it as a PDF, because the tool is continually, or we believe, continually being re-engineered behind the scenes. And you don't want to find that when the tax man comes in, you rerun the checks and find it gives you a completely different answer because they've changed the weighting of the tool.
One more and I'll let you continue. So somebody's asked about if the individual's based outside the UK, will they need to complete the tax status? I mean, presumably that's similar.
So similar point to earlier. As long if they're outside of the UK and non-resident, so it's not just that you're sending somebody who normally works in the UK to go and work in Paris, New York, Milan, wherever, just glamorous places. Then you would still need to consider them because they're likely to remain UK tax resident if it's a fairly short trip abroad. But if they're genuinely living out there, if you're engaging, let's say, Croatian IT consultants, then that's fine. They live outside the UK, they're non-resident, and they fall outside of these rules.
I am going to put one more question in. This is a good one. So we are a small company on our own, but we're owned by a large overseas holding company.
It is a good company. I'm meaning to update the slides to cover that off. Yeah, the test is a group test. So if you're small in isolation, the fact you're part of a larger group, I'm afraid, is going to cause you to not be small if on a group basis you're. And
that's regardless if that group is foreign owned or
I'm pretty sure. I'm just doubting myself and saying I'm pretty sure there's the small company test is agnostic as to whether the larger group is within or outside of the UK. But if whoever's asked me that question wants to drop me an email, I'll just check that for you. I'm pretty sure it's the group, full stop. Doesn't matter whether it's UK or non-UK.
Yeah, and somebody's made the point actually that new companies will always be small because they won't have had the 2 years where they could fail to.
Yes, I think that's probably right. I'll just question whether that's true if they're a new company that's part of a group. But if they're a new
standalone part of a group, then
just a moment of doubt if they're part of a group. But certainly if they're a standalone, yes, they've got 2 years. But good luck if you're going to be a startup and get to 2 years of 10 million plus revenue in your first.
Well,
we'll be interested in acting for you otherwise. But, right. Good. I'm going to go on because I'm conscious that there's a couple more bits to check. So right, employment status. The tool is there to try and interpret this mountain of case law. Just be aware. I won't spend very long on this. The definition of what employment status is constantly a political hot potato. There are calls, even in the press, in the last couple of days, to have a statutory employment status test rather than a case law based one, and that's largely driven by the gig economy. Because actually, if you're on a motorbike delivering pizzas for Deliveroo, you probably pass all of the standard tests for being a self-employed person, even though the courts don't always agree with that. So the test may change, probably won't change very soon because the people writing the law are rather concerned with Brexit and COVID right now. So the revenue love to take high profile cases. Lorraine Kelly being the one that gets talked about a lot. Lorraine won. Lorraine was a complete loose cannon in some ways. They weren't engaging her, they were engaging the brand that is Lorraine. They had no control over Lorraine Kelly as an individual. Good luck trying to control Lorraine Kelly. The Kay Adams from Loose Women fame also won. I think she won on a mutuality of obligation point that her contract could have had her sacked at a moment's notice. So she won, and then at the end, Helen Fospero from who stood in for Lorraine, I believe, on occasion, she won her case as well. The revenue hate these high-profile wins. They're rather going to task on Eamon Holmes. Eamon Holmes lost. Eamon Holmes now publicly is appealing his employment status case because he wants a bit of Lorraine Kelly's action. So he is appealing. It will cost him a fortune, and the revenue will fight with every fibre of their being to win. They do not want Eamon Holmes actually scoring a case law precedent for self-employed. So that's one to watch. His appeal won't be heard for a few months, but he is appealing it. Then we've got the trio there of Tim Wilcox, Joanna Gosling and David Eads, all TV presenters, they all lost. And then Paul Hawksby on Talk Sport, he lost on the basis he'd been doing the same show for 18 years, had a pretty secure contract. He worked for Talk Sport exclusively, so he lost as well. And there are many others. And so the case law is continuing to develop. The CEST tool isn't updated as these cases are heard. So particularly the mutuality of obligation point, is the individual required to do the work? Is the client required to offer it? That isn't covered in the CEST tool at all. That's the biggest criticism. And if you look at somebody like Kay Adams or Helen Fospero, they won on those points, and Paul Hawksby lost on that point. It is a critical point. And perhaps going back to that earlier question about what happens if you get an inconclusive response, probably another place to go is to look at the strength of the obligations in the contract. What's the notice period? How long have they been actually working for you? You may be able to make a case to tip the balance in favour of self-employed just on the mutuality of obligations test, which the CEST tool doesn't consider for no good reason. Agencies, I said I'd mention. I'm just going to do a picture rather than the words. The words will be on the slides we circulate later. So if you find your personal service companies through an agency, this is how it works. So you've got the same worker on the right-hand side of the page. You've got the same personal service company that invoices the agency, or more likely puts a timesheet in. It's the agency that has to then deduct the PAYE, not the end user, the client. The only thing the client has to do is provide the status determination, because only the client knows what the worker is doing. So the client provides the status determination to the agency, and based on that status determination, the agency will either deduct PAYE tax or not. In using agencies, and agencies have seen this as being, so I mean employment agencies rather than marketing services agencies, employment agencies have seen this as a business winning opportunity, because clients, the end client, doesn't want to bear all of the admin of dealing with this. And if you engage all your PSCs through an agency, you carry on just being invoiced and paying gross, and your only obligation is to provide the status determination. Some agencies out there have said, hey, we'll take all of the admin off you and we'll do the status determination for you, based on our own tool. I know, Juno, I think, have a tool which they put together with one of our competing firms of accountants. I think they are offering to do the status determinations. I would just exercise a little caution there, because the obligation to do the status determination remains that of you, the business using the worker. Agencies might do some of the heavy lifting of the admin for you, but you still need to make sure you're happy with what they're doing, because you're going to be the one paying the bill if it's done wrong. That's agencies. Now, in all of this, we know our freelancer population are the most easygoing population. They're pretty laid back. They kind of take things in their stride. So when you pay their invoice and knock a few quid off for the tax in the future, they'll probably be fine with that. Or in the real world, they might dispute the fact that you've determined that they're acting a bit like an employee. There is, in order to make the regime work, and lots of words on the page, I'm not going to read anything like all of them, there is an obligation on you, the client, the end user of the freelancers. If you're not small, again, if you're small, you don't need to worry about most of this stuff. If you're not able to rely on a small company exemption, then you must have a dispute resolution process. That's a legal requirement with penalties for not having it. When in the consultations it was said, look, that's a bit of an admin burden on businesses. That final sentence is the one I always draw to. This is what the government said, public sector and medium and large size private sector organisations are likely to already have relatively sophisticated HR processes in place, either in-house or subcontracted. Yeah, okay, Moore Kingston Smith is a sophisticated, medium, large size private sector organisation. Yes, we have got a very sophisticated HR team, but they're fully occupied doing everything else they have to do. We know when we walk in and say, you now need to deal with our freelancer dispute resolution process as well, that's additional cost and hassle for us. So I think the government are being a bit disingenuous, saying it will just be fitted into the normal workload, because the disputes you're going to get from your freelancers will pretty much in every case where you determine they're an employee. The dispute resolution process, again, lots of words, not going to read them all. It's reasonably straightforward. It's just a framework where the worker can dispute the status determination, offer up additional evidence that you, the user of their services, must consider, and then you reissue your status determination or not, as the case may be. There's no need for it to be escalated up to a higher power. The only thing to watch out for is you have a legal requirement to respond within 45 days. So if you go outside the 45-day period, then there'll be problems in terms of penalties and compliance issues. So if you are within this regime, you've got something less than 6 months now, I think, to work out where your dispute resolution process is going to sit within your organisation. Esther, sorry, you look like you're about to draw a breath.
Yeah, no, I was just going to say, somebody has asked, I think you've kind of already said this, but just to clarify, so if you are small and if you are engaging with a PSC, you do not need to provide this determination, do you?
No,
whereas if you're small and you're engaging with a freelancer who is just invoicing you personally, then you should already have been looking at this for a number of years. Yeah. And most likely what we're saying to most clients is probably just put people on the payroll to be risk averse, so that you haven't got any exposed liability.
Yeah, I mean, in the good old days, when you're engaging flesh and blood freelancers, you'd say, look, our policy is we don't engage individuals, either come to us through an agency or form your own company, and we'll engage with you that way. I was selling a business many years ago, and we said, you've got a problem with your freelancers, and they said, no, little old Kingston Smith, you don't know what you're talking about. And they engaged Deloitte, I think, to do a low, medium and high assessment of their risk. I think the low was 200,000, the median was 500,000, and the high was 1 million of additional tax, and it killed the deal. The risk around paying freelancers and getting it wrong is potentially so large because you're effectively on the hook for their tax. And if you use a lot of freelancers, that can grow to be a very, very large number.
What about if you're using an agency in between? Is it the agency's responsibility, or?
It's the agency's responsibility unless you choose to use an agency in Panama or the BVI or Liberia. If you use an agency that's sitting in somewhere that's a bit more difficult to find on the map, all of the agency's liabilities will travel back to you, and more for you for using an offshore agency. If you're using a UK agency that's legit, and you need to do some due diligence on your agencies, that's another obligation under this regime, then you're protected from those liabilities traveling back from you. It's the agency's problem.
Good question here. Do you count the number of PSCs in the number of employees? Because if you used all your resources PSCs, then you would always escape that criteria.
Very good question. Yeah, no, you don't. It's a dumb test. If you are one employee in the business and 10,000 PSCs, no, you're one employee for applying the small company test. Because
often, even if you fail the turnover test, you might survive the gross assets test.
Yeah, but the gross assets test, it's very, which business has assets these days? The tests that people are failing are the turnover and the headcount test.
Yeah.
And the headcount is reasonably manageable by using freelancers rather than employees. A turnover, you'd never want to try and duck this regime by saying, let's keep our turnover down. That would be nuts. I'm conscious we're 5 minutes from the end. I've probably got 10 minutes of content, so I'm very happy to run over. I do appreciate other people might have other things to do, so I'm going to carry on at my breakneck speed. Esther, do interrupt with pertinent questions, but just putting people on alert, we might be 5 minutes or so over.
Yeah.
Right, February 2020 review. This was when the government said they were going to really seriously consider whether to scrap the whole thing in order to win an election. And then when they reviewed, hey ho, they said the reform's going to go ahead anyway. They did also say in the review, look, the penalty regime in the first year is going to be light touch. Well, look, no one really cares about the penalty regime. They weren't very big anyway. What we care about is the obligation to pay national insurance and deduct tax at source. And there's no light touch on getting that wrong. So the penalty regime, that's helpful, but not as helpful as it could be. The revenue have come out again to say that they're not going to open up investigations into freelancers for years prior to April 2020, based on intel that they're gathering now under this new regime. That will keep some freelancers happy. The point I made earlier about the new rules only apply to services carried out when this was announced April 2020, but now April 2021. So if there's an invoice received after April 2021 that spans the before and after period, you're only applying these new rules to the services provided afterwards. And then a rather silly final point that came out of this review: businesses have a legal obligation to respond to requests about their size. Are you able to rely on a small company exemption? Well, look, most informed freelancers would just go and check Companies House, but perhaps all the detail isn't there. So if you're asked by a freelancer, that will be because the freelancer will prefer to work for small businesses, and you now have a legal obligation to tell them before you engage them. So this is the home straight. So are you ready? I divide this into clients, so businesses using freelancers, and then the freelancers themselves. Yikes, I'm a client, what should I be doing now? Well, first of all, can you rely on the small company exemption? If you can, brilliant. You can forget most of what I've said for the last hour. You can carry on business as usual, but bear in mind, in 3 or 4 years' time, that small company exemption will probably go, and you'll have additional cost in using your freelancers, probably the employer's NI. And for as long as you can rely on the small company exemption, there might be some sort of nice collaborative work you can do with large businesses. You're more competitive in the freelancer market. So small company exemption is useful and helpful for a few years. If you can't rely on a small company exemption, be prepared for your freelancers to not want to work for you. I mentioned actually to one of Esther's clients, said, well, look, be prepared for your freelancers to go and work for smaller businesses. And they sort of laughed. And when they finished laughing, they said there aren't enough smaller businesses to absorb all the freelancers that we use. And that's right. The whole freelancer population can't just go and work for smaller businesses, but if you're competitively going for one freelancer and they've got a choice for working for a small business or you a large business, you might find that you're in second place there. If you're large, you need to look at your current workforce, work out whether how big your problem is. I've done that for more Kingston Smith, and it was a nightmare. We go down our list of suppliers, and our supplier is called Blue Jelly Limited, and I say to my board ledger, is that a personal service company? They say, I don't know. The budget holder knows. Go and speak to somebody in IT, and you go and speak to somebody in IT, and they don't know either. The information you will need to know whether you've got PSCs on your list of suppliers actually may not be readily available. Start looking now. If you've got a very long list of suppliers, it will take a long time. When you've found your PSCs, you've actually worked out which businesses you've got contracts for personal service with, run all the facts through the robot. If the robot says you're fine, you can carry on business as usual. If the robot more likely says you should now be putting these freelancers on the payroll, look at what the tipping point is. Can you change the way you engage with your freelancers to actually tip it the right side of the rules? All of that needs to be genuine. You can't artificially change a contract, but as long as you can genuinely change a commercial arrangement, you might find that cures the problem. If you use agencies, start the conversation now. I'd hope most responsible agencies have already been in touch with you. Their systems have been upgraded over the last 18 months or so. For as long as we've known about this, they've developed all sorts of platforms where you've got to upload your status determination onto the platform and do all sorts of clever things. Figure all that out now. What's the information flow going to be between you and the agency to make all of this work? If you do accept the robot's conclusion that your personal service companies are within these rules and you can't rely on a small company exemption, what are you going to do about the additional 13.8% or 14.3% cost? It can only go to one of three places. You can either chip the freelancer on their day rate, good luck with that. You can either, your clients that you're actually charging for your service, you can push the cost onto them. Yeah, good luck with that one as well. Or it goes to your bottom line and makes you less profitable. That's the easy one, but that's the least palatable. In reality, it's probably a bit of all three. you know, think about where that additional cost is going to go. If you are a business with 1 employee and 10,000 freelancers, are you viable anymore? Does 14.3% on your costs cause you to be, you know, a non-viable business? Check the contracts you've got. I mentioned that very briefly earlier. Your contracts with your personal service companies may not allow you to make any deductions from payments. So if you start deducting tax and NI, you are theoretically in breach of contract. So that is something to watch out for. You may need to amend the contract terms with your personal service companies, which will require their consent. And start thinking about your dispute resolution process. You know, it's certainly in the first month when you make your first status determination and first payments, your freelance population is going to go rogue. They are going to kick off big time, and they're going to dispute the that you've determined them to be employees. So you need to make sure that you've got a process in place to make sure you're responding to those disputes within 45 days. If you're a personal service company, so if you've got any freelancers on the webinar, you know, what should you be doing? Well, it's sort of the flip side of everything I've just said. Run your facts through the robot. How bad is it? Hint, it's probably very bad. And I've done this for a few of my chums who are freelancing. Not one of them has been in the clear to be, you know, a self-employed freelancer going forward. Do some number crunching. Look, if you just accept this regime is coming down the track, if you're a freelancer and you've structured your affairs very tax efficiently, let's say you own your company that you operate through with your spouse, if they're not earning very much, if they're home looking after family, and you're splitting the dividends either way, you're probably sneaking a few expenses through the company. Let's put the dog food through the company. I've seen that one before. You know, the chances are you're probably not paying very much tax. If you end up having a tax and national insurance deduction at source where you can't deduct the expenses and you can't income split with your spouse, you're going to get poorer. And you know, does that, you know, what does that mean for you? Think about that now. The one that came up with a chum of mine that lives over the road from me, and we did it over a coffee as the kids were doing their Saturday morning sports, is he was about to remortgage. And I said, well, as far as I know, so far the lenders haven't cottoned onto this yet. They hate freelancers anyway, but I don't think they've cottoned onto the fact that the disposable income of freelancers is due to fall from April 2021. If you're a freelancer and you're going to remortgage, I would get on with that, because if the lenders put that in the affordability test, you may find that you're unmortgageable. If these rules are a problem, can you only work for small companies? If you can, it's probably only a short-term fix, because I think the small company exemption won't be around for very long. Can you renegotiate your contract? Can you push up your day rates? Can you resist any clauses for tax indemnities or tax deduction at source clauses? And if you decide all of this is all a bit much and you've had enough of freelancing, you know, and you want to take employment somewhere, can you do anything clever with your personal service company? Can we take the money out in a clever, tax efficient way? And come and speak to me about that if you want more details on that one. That is everything, and I'm 4 minutes and 3 seconds over, but I suspect we've got some questions, Esther. So I think that those who need to go, by all means go, but we'll stay to do as many questions as Esther will fire at me.
There are a couple. A good one here was about the number of employees. Is it the full-time equivalent, or is it just the number of employees on the payroll? Because that could change things quite a lot, I think, with the more people becoming part-time and flexible.
Well, there we go. I'm going to put you on your toes, Esther. It's the Companies Act definition. So when you're doing the small companies test for audit,
I think it's the number as opposed to the full-time equivalent, if for that.
Yeah. So if you want clarification, that drop Esther a line, because it's a Companies Act definition rather than a tax definition.
Right. Okay. Fine. Yeah. I think it's just the number then. And somebody's asked also if they're getting a different answer from the film and TV industry guidelines as to whether they can assess Schedule D status. Can they use that instead of the CES checker?
Yes. Yeah. The film and TV industry is a very powerful lobby group, and they've got that wonderful document which it supersedes the CES checker because it's all industry specific, and it's really good. As I say, it's been updated, I'd say, in the last 9 months or so. The only other industry that I've come across that have got a similar document is horse racing, where there's a guide put out about the people you'd find in stables. Probably not many horse racing businesses on this webinar.
No, I doubt it. A very specific question here. What about UK tax resident contractors who would usually fall under IR35 for work carried out in the UK, but where for a specific project they're hired by a UK company to carry out work that is 100% outside the UK, such as the Middle East? Will they need to be given SDS and have tax deducted on those projects?
Yes, because if they're going to work in the Middle East for a while, it would be very unusual for them to be working for a long enough period to break, excuse me, their UK tax residency. They need to be gone. You know, if they left today, they need to be gone pretty much until the end of the following tax year. So they'd be gone for 18 months, and you know, not many people are taking on roles to work in the Middle East for 18 months. So if it's a very long project, where the individual worker might lose their UK tax residency, they're outside of these rules. But I would say in 9 times out of 10, they'll remain UK tax resident, and therefore the fact they're working in the Middle East is by the by, wouldn't change the rules.
Okay, and somebody's asked, well, they're sort of assuming that if we're going to be deducting tax at source, then we'll need to be collecting people's national insurance numbers, which I'm assuming is
I skipped over the slide. In order to actually, when you send out your status determination status, you should also be sending out something called a starter checklist, what in the good old days used to be called a P46. And the freelancer is going to have to fill this out as if they were an employee, and they'll put on their name, their address, their national insurance number, and they'll tick a box saying this is not my main employment. And it's a slightly stupid thing to do, because their main employment is with their personal service company, so they're more or less saying I've got a second job, and that's what gives them the basic rate tax code. But that's the form that will need to be filled out. Anybody who wants advice on this, we can tell you what your status determination status should look like, status determination status statement should look like, and what form should go with it. All admin, but very important.
Okay, and final question, or is more of a request, could we share the link for the TV film rules? I guess we could send that out at the same time we send the slides out.
Yeah, Harpreet hopefully is listening in. When we send the slides, we'll send around the link for that. It's a really useful guide, little bit difficult to interpret in some places, so do come back to us once you've had a look if anything's not clear.
Okay, super. Well, I think we will wrap it up there. That's all the questions done. Thank you very much, Tim, for your time. Thank you everybody for having joined us. And we look forward to seeing you at future webinars. Have a good day.